A rapidly expanding segment of the crypto and derivative space is attracting growing attention from traders, platforms, and regulators alike as a new high leverage product continues to gain traction with retail investments around the world. The rise of these instruments has sparked fresh debate over risk, transparency, and market oversight, particularly as trading activity shifts further into decentralized platforms outside traditional financial systems. I'm now joined by Brendan Caldwell, director of Caldwell Securities Limited, to help unpack what's driving this surge in popularity and what it could mean for investors and regulators moving forward. Brendan, thank you so much for the time.
Well, this will be a fun one, I think. It's the wild west of finance, and this is very much the cutting edge, and it's been impacting the whole market. So let's do this. What do you want to know?
Come on, Brendan, they're always fun. But let's start with, what are perpetual futures and how do they differ from traditional derivatives?
Okay, so normally speaking, you've got some sort of contract between two parties. Could be an option, which gives you the right to buy a certain thing. Could be an index, could be a stock, or to sell that index or stock at a certain price for a certain length of time. To do that, you need to put up a bit of money, and somebody is selling you that contract, and it's a bet each way. You might do that you might buy that options contract as speculation. You might do it because you want to buy the stock at a certain price, or you want to sell it at a certain price. So there are lots of reasons you could buy an options contract, and they are a leverage product, so that there is some upside. When I say leverage, it means that the amount that you put in isn't necessarily proportional to the amount you could make, or in some cases lose. The way it is with if you buy an actual stock, the amount you make and the amount you can lose, they're within order of magnitude about equal over a reasonable period of time. A futures contract, something similar, but usually those are around commodities, sometimes around stock indices as well. And futures contracts also have an expiry date, and you have to put up some margin, some guarantee, usually at least 5%. Difference with these new contracts called perpetual futures, they don't have an expiry date. They're just an ongoing forever bet on whether a stock goes up, or really anything that you want to bet on, or whether a stock goes down, or whatever it is you want. So this perpetual bet means there's a tremendous amount of leverage. And what is interesting about it is that it's really not on any platform. It's not on the Chicago Board Option Exchange. It's not on the Chicago Mercantile Exchange, at least not yet. And not even largely being done overseas, outside of the United States of America, as a way to have highly leveraged. I mean, we're talking 20, 30, 50, 100 times leverage. So you put down $5 to get $100 worth of participation in the market. So there's a lot of potential upside, but there's also a lot of potential risk. And this is, as I said in my introduction, the Wild West, because there really is no regulation around this whatsoever right now.
And Brendan, what would you say is driving the explosive growth of decentralized perpetual futures markets?
Because they can. The blockchain, crypto technology has allowed for this decentralized. I mean, the whole point of blockchain technologies is decentralized transfer of money, of wealth. And well, I'll come to that in a second, where the wealth is mostly being transferred. So by bypassing traditional exchanges, investors and those that are making a market in a security or a perpetual future can really make their own rules, separate from the margin rules that regulatory organizations like the Futures Trading Commission, or the Securities Exchange Commission in the US, or the Ontario Securities Commission here in Ontario make. Apart from all that, you can make your own rules. And what normally happens is that, if you want to put a bet on something that Microsoft is going to keep going up forever, you could put $5 down on that bet. And as long as Microsoft keeps going up, you can have the leverage of like having $100 invested. So 20 to 1, 50 to 1 leverage. The downside, of course, is that if the market goes against you even a little bit, your account gets closed out, done. That's it. All your money's gone. But it's attractive as a way to take this decentralized blockchain technology without the rules, without all the headaches, without having to go through a broker, without having to worry about regulators, and just do whatever it is you want to do in the financial markets. It's kind of like Napster was to the music business. What was that, 25, 30 years ago, before Apple and then Spotify came in. It's the Wild West, the way the music business might have been in the 90s, early 2000s.
And what are the biggest risks for retail investors trading perpetual futures?
Well, like in the real Wild West, the biggest risk is you get shot with one projectile or another. With this, as I think there are no regulations, there are no oversight rules. So I think the biggest one for most investors is that you might think Microsoft is going up forever, and you might be right, except when it just blips down a little bit, you're wiped out, your account's closed, and that's the end of it. So all the money you put up is gone. It's like a South Park episode, and it's gone. So that's the one risk. The other risk is something a little more esoteric called counterparty risk. See, if you and I, Theresa, do a trade in the market, we don't know who each other are. We never talk. But we have an intermediary, the stock exchange, the futures exchange, the options exchange, and the underlying clearing corporation that settles the trade, so that even if I'm wiped out, or you're wiped out, or the other side, for whatever reason, can't settle, the clearing corporation makes sure that there is money there to settle the trade. So you would never know that the other side couldn't pay up, because the system will look after you. In the case of these perpetual futures, there is no intermediary. You have direct counterparty risk. So that's the reason that accounts get stopped out the second that they're out of money, because the people offering the perpetual futures don't know if you're going to put up more money, and maybe will, but more likely you won't. Flip side is, I could make a bet on which I make 1,000, 10,000 times my money, but if the other side isn't able to pay, sucks to be me. I think it's the technical term.
Now, Brennan,
So
we do only have a bit of time left, but how are regulators responding to the rise of perpetual futures? We only have about 30 seconds.
Well, then the regulators won't get there in time. They're acting slowly, as regulators always do. I do think that most of the money, like 99% plus of the money is going to a very small, less than 1% of the accounts are making all the money, because it's like a casino on steroids, that the house always wins. It's not always true with casinos. In the case of perpetual futures, in this unregulated world, the house is always winning. And I think regulators will eventually catch up to the system, but it's going to take them a minute.
Well, Brennan, thank you so much for the time.
Thank you.